All right, good morning. Welcome back here to Trader Minute. Great to have you aboard. Market doing the opposite of what it did into the close yesterday. After I got off video yesterday, we saw the market just ripped about 120 points to the upside. And yeah, I mean, big up move and everything else there. And then, here we go. Dun, 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 all the way back down with some immense volatility along the way. I mean, overnight we saw a 60-point rally in futures. We saw here just from 7 o'clock my time, 9 o'clock Eastern, till, 35 minutes later. We saw what was this, a 50-point rally. It has just been, the pace of movement here has just been astounding. And, it's one where we've already talked about it a lot, that when you have these big upticks at such a pace, those aren't bullish. Those aren't things you look at and say, well, because the market has moved up so much, it's bullish. No, when things move at that pace, that's typically not a bullish sign. Some flattening out, some tempering in the volatility, those tend to bring money into the market. Outside of that, you're just talking about algorithms, you're talking about, dip buyers, you're talking about those that are willing to unwind positions minutes, if not hours later, and we continue to get some of the incredible volatility that we see here in the market. Last week I talked about three charts that are very important in this market. Let's bring them up here. Let's go John Hopkins coronavirus map here. Let's see. We'll Google search it since I don't have the link there, and let's see if that brings it up. No, yeah, there we go. All right, so we talked about the charts that are the most important right now in the market, and this one down here, if it'll let me get there, here we go. This one down here where it shows the new cases of coronavirus. We need to stop seeing this grow exponentially, and it continues to grow exponentially there. So more than 1,000 cases now in the U.S. It's even come here where I am in Salt Lake City, but you can see it's dotted here throughout the U.S. and it's just one of those things where you can make a really good argument that there are more cases than what we see here, simply because testing procedures have been slow to, or even testing kits have been slow to get to certain areas. I know where I live, it's been very slow, but starting to increase. So it's just one of those things where the spread looks like it's going to continue here, and continue exponentially for the foreseeable future. The other chart here is the TLT, the bond chart. We need to see that this is topped. Now, there's a pretty good argument that this is topped based on the overall price action here with bonds. And I think that's a very interesting argument there, one that is definitely a better argument than talking about coronavirus stopping. And then we need to see the banks bottom. And there's a little bit of argument that could be made that they've bottomed, but it's not a great one. It's not one that's a super high probability. It's one where, we saw some price action the last 2 days that suggests, this could be making a bottom right here. And I do think, if today it's able to hold up around these levels and continue to trade around these levels for a number of days, it's a lot safer to say bottom is in. But, so far, it's still a work in progress. So we have one chart where it's absolutely no, it's not changing. We have another one that has some very strong topping signs, and one that's just kind of right there in the middle of bottoming signs. So nothing overwhelming in either direction here, just yet. So anyway, keep an eye on yesterday's lows here in the market. If those get taken out, we will see another dose of selling. If you're looking to trade to the upside, take a look at the overnight highs on futures. Well, not overnight highs, but the European highs on futures right up here in 28.36. That level gets broken. We likely see a big chase come in here in the market if that level is taken out later on here today. No new challenge trades here on the board this morning. A couple things with challenge trades. We need to have crossover first, right? Then the crossover needs to give us some sort of bearish signal, and then we need to have an option that is tradable. So here this morning we have Triple M that has a downside 3-7 crossover on it, but the consolidation risk on it is very high right here. This is a very interesting stock, how it's traded throughout all of this. And we'll talk about Triple M when things settle out and whatnot there. But very interesting price action on it. And then we have Walgreens, WBA. This is one that last week had upside crossovers, has a downside crossover today. But very high consolidation risk here for it. So far. So nothing I can go out and get into here for the challenge. I'm still willing to go buy S&P calls if and when when the market vibe changes and goes bullish, but it hasn't. And one thing I have to make clear is the fact that the market vibe isn't going to go bullish because of a magnitude of a rally. So yesterday we have a 140-point rally on the S&P. That's not going to magically change the market vibe and say, well, okay, all of a sudden the market vibe's now sitting bullish. Magnitude, as we've talked about, is not a factor in the market vibe. The market internals are. And, we saw yesterday, a really big rally. But when you look at the number of stocks trading above key moving averages, the number of stocks trading above the 7 yesterday was still very low. It's even lower today. But even the early snapback signs aren't snapping back in a big way right now, even with a 140-point S&P rally. So nothing to do with magnitude, everything to do with the internals, and it'll stay that way. So it's one where, okay, fine, we have a 100-point rally, great. That's all well and good. What do we see going on in the internals? Do we see those changing, shifting? And the fact of the matter is, no. We don't. In fact, they are still very bearish overall. And even yesterday, with a 140-point rally in the S&P, the bullish percent index went lower. You don't see that almost ever. Just the nature of what we are in right here and right now. Okay, so challenge going to remain in cash. Again, We'll jump into the next things that trigger, but I will be patient through all of this. The challenge algorithm and the challenge itself is not built to go out and try to predict in every move. It's to wait for the predictable ones, and right now those just don't exist. Now, that doesn't mean I'm not doing anything in the market. And Michelle forwarded me over a couple questions, and they all centered around what am I doing in the market right now, and could I share some of it? And I've shared some things, as we've ticked along. But I thought this morning I'd share some of the stuff that I've done, some of the mentality behind it, and then the play that I'm looking to put on next. So let's get to it. As you know, going into this big market slide, I have been very lightly invested. I was very lightly invested last year. I missed much of this upside rally. I had a few plays here and there, some nice Netflix and whatnot, but nothing too dramatic. And so went into this with a pretty high level of cash and low level of exposure. So I've been able to look at this from a where do I want to build perspective rather than a where do I have to cut. And, that's a very different mindset because most of the market right now is in the where do I cut mode, where do I have to trim, where, okay, great. I'm more in the where can I build. Now, does it mean that one's bad, one's good? No, not necessarily, right? I'm in that mindset because I missed much of the upside, where others are in that mindset having run much of this upside there with it. So, to each their own there, but for me personally, that's how I'm looking at it. I know the option market for directional plays is dead for me. The risk reward on most options just doesn't make sense. Even with spreads, there's some just ridiculously dumb values out there. So, from an option market standpoint, the only thing really open to me is to go out and sell some puts. And I've done that a little bit. I mentioned Boeing. When we first had the first big drop here, and Boeing came down to the 280 area, I went and I sold some puts. Now, those are going to get put to me. And Boeing is at 210. So, my 270 entry price, having sold those puts, doesn't look so great. So I'm going to get put the shares. I'm going to be holding the shares, and that's fine with me. It's just one where I'm okay with that. I can hold this for years. I don't have to do anything with it. But I did take Boeing off my watch list because every day I see it down, I'm tempted to sell some more puts. And I can't get myself into that position to where I have the position so oversized that, I need to have a bottom or I'm getting knocked out. For now, I can be very, very patient. But if I start adding a lot more without a bottom being in, I'm not in that position. So I have to be very careful. Boeing's gone off my watch list to where I'm not really going to assess it for a while. I need to see a bottom in before adding, and I will ultimately add as I don't have a full position yet, but I do have to be a little bit careful. The other day, when we saw the market down 7%, I went out and I bought some Walmart. I went out and bought some Amazon. Partial positions on both. Amazon's up nicely since. Walmart is down probably a little bit now since. But both starter positions for these, both stocks that I want to be involved with. Amazon more so from everything going on before the wreck that we've seen in the market. Walmart more for the oil aspect and the big change in oil and energy. So did add a starter position in both of those. I've been watching Chipotle, been watching Starbucks, looking for an entry. I haven't pulled the trigger in them yet, with these restaurant names. But the one kind of free faller that I have pulled the trigger on is Bank of America. And I ended up picking a little bit up last week and ended up picking up more yesterday, selling some puts on Bank of America because the puts are just incredibly overvalued. So I've started a position there. I do have room to add more of a position. But I'm in a position right now to where I have to look and say, hey, Jeff, if you keep adding right here, you're going to be in a position where you have to hedge, where you have to buy some hedge to protect against the crash. Right now, I'm not exposed enough to where I feel like I need to hedge. I can be patient and everything else. I don't need the hedge. But if I start adding more, I do need the hedge. And hedging prices are absolutely ridiculous right now. If I just want to go out and use the S&P to hedge right now, and let's just take a look at the SPY, and I want to buy a hedge for the next 100 days, and I want to buy the put options to hedge, I'm paying almost 10%. That's huge. That's absolutely huge. And there's a good chance that we can see the market bleed lower and my hedge go down. So is it really a hedge? No, it's not. So I look and I go, Visa's very, very intriguing to me. I think Visa's a really interesting value right here. But I have to wait. I have to be patient. I am looking at this point at one more thing to add, and then looking to add when I'm comfortable. Some of the bottom is in. And right now I'm not comfortable enough that the bottom is in to up my exposure to a greater level here. Okay, so that's what I've been doing. Outside of that, I have been doing some day trading, and I mentioned the other day, I'd been doing some day trading. I caught some nice trades, and then on the up day where the market came up here to 312 on the S&P, I took all my day trade gains and I rolled them into a SPY put spread. And I mentioned it on that day, put it into a big SPY put spread, and it was on this day right here, right before the day that it dropped and the day that it popped. So I had to ride it for a couple days. but put them into a SPY put spread. Ultimately, that put spread paid off on Monday. I took it off, for almost full value. I did have to give up 25 cents because of the, just the ridiculousness of the spreads and some of the pricing that's out there right now. But that's about all I've done from an option standpoint. And I do continue to do a few day trades here and there. I haven't done any the last couple days, but I will going forward. I'm simply using the method that we looked at together back during the holiday season last year. That video is there in the video library if you want to go check it out. I've showed it a couple times, but I'm just using that simple method and running with it. The SPY options are what I've used to trade it. They are incredibly high priced, but which makes no sense to trade from a day-to-day perspective or whatnot. But from a day trade perspective, it's still not bad. It's still something where I have to realize my delta is very different. Right, so the amount of movement I can expect to have is very different. So I have to increase my exposure. I have to buy a little bit more to get some of the movement that I want. But I'm also not sitting here with a lot of time decay and volatility risk as they're day trades. If I'm holding it longer than that, then I do have that risk. So, yeah, the risk-reward elements are very different with the SPY, but I can get about the same that I'm looking for in a day trade just by adding more exposure, and I can get about similar risk, similar reward as with how they are moving. I can't get that with going out longer, with buying calls and puts for several months or something like that. I can't get the similar risk reward, but with a day trade, it's no problem. I just have to up the number of contracts that I'm doing. I have zero interest right now in the energy sector, and I'm not looking to start a position. I'm not looking to do anything here in it. I know Halliburton, it is down here at $8. This is a stock that I looked at last September and October and thought, man, there's a really good argument that bottoms are in, and we could see Halliburton be one of the best performing stocks this year. And that was kind of what I went into the beginning of this year looking for and looking at here with Halliburton. But there's been an absolute game changer here. And so I can't look and go, well, I thought bottom could be in here in September and October. So now, okay, well, it's down at 8, so bottom no, the game has been changed. And Halliburton probably has more bankruptcy risk right now than it has to go back to 20. It is one where the Saudi action is an absolute game changer, and it's one that you can make a pretty good argument many in the industry knew was coming and knew was going to happen with how things traded in all of U.S. energy. And I do think there's some known elements there, or people that knew exactly what was going to go on, and people who took advantage of that in a very big way. And that's just the nature of the market, and there is that absolute corruption that does exist and will always exist here in it. But I am not interested in buying Chevron. I'm not interested in buying Valero. I'm not interested in buying Exxon or Conoco. Not right now. Not right now. Not until I see some reason that I can safely assume that a bottom is in. Because the way these are trading, they're trading like some of the metals did not too long ago, to where they just, you can make some good arguments that they should be going higher, but they just took an absolute nosedive, and they're continuing to do so without real chance of bounce. U.S. Steel, one of those here. 2018, the beginning, it was in the 30s and 40s. Went down to 20, now down to 6. Halliburton could easily be in that position to where it's a penny stock in short order. Transocean, Right? I mean, Transocean rig. I mean, it's down to $1.50. This was a $15 stock a couple years ago, down to $1.50. And there is serious risk, in my opinion, of other energy names going the way of Transocean, especially the ones that are highly exposed here in the U.S. In U.S. markets, which are most of the ones in the stock market right now. So I have no interest in it right now. That could change if the story changes a little bit. But there's one play that I do have an interest in, into adding before I see some sort of, bottom in the market where I go, yeah, this is more than just bottoming signs. This is pretty good. Pretty good chance that the bottom is in. That is, I would like to play some VXX on the downside. The VXX always goes down. It always goes down. That is one factor in the market that we can look at and say is an always. Now the VXX gets changed, gets rolled, and everything else, so we can't see the big long-term chart. But the big long-term chart is a chart that just always goes down, and as they reverse split it, it goes down more and more and more, and it goes down more and more and more and more because it's based on, the futures, and so there's a futures value that gets eroded in there. And so when it has these periods of pop, right, these periods of pop, like here in August, had a period of pop, and then boom, 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 boom. Drop, gave up 50% of its gains in a matter of months. So how do I play this? Because it could still go higher in the short run. This is something that could still move up to 60 or 70. So how do I play this? How do I get involved in this? Well, generally, if I want a longer-term type of play, and I know option values are ridiculous, I look for a spread. So in the case of VXX, I'm looking at a put spread, and I'd like to get out 100 days or more, so get into June, and just kind of see where things would pay off. Because for me, VXX dipping below 30 by June, that's kind of a no-brainer. Even if we have more turmoil in the market right now, the VXX is going to drop. The volatility index will drop. The volatility index has no history of staying elevated at current levels for months and months and months on end, except for during the financial crisis. So I go, okay, yeah, we could be in that position of a financial crisis, but chances are we're not. So can I get paid to bet that that will change? So I come look at the VXX, and the one I'm looking at is the June 30 and 29 put spread. If I put in a limit order right now, I could probably get this for 45 to 50 cents. What does that mean? Well, that means that the best I can do is about a double, right? This is a spread that'll be worth about $1. But chances are I won't be able to get out of the dollar until expiration, so I'll probably end up getting out at 90 cents. So if I pick it up for 45 cents, I can have a double. That's not all that great, but it's still better than a lot of other options out there in the market. If I go down a little further, I can get better pricing. I can get into the 25-24 and maybe get this for about 30 to 35 cents. But now I need the VXX to drop a whole lot more. So, what, 45, 50 cents, 40, 45 cents. That's where I'm kind of looking to get in on this 29.30 put spread. And I haven't gotten into it yet. This is kind of the last thing I'm willing to add before having to hedge my portfolio. But it's one that, I think has a very high probability of success. I do not want to add it on an up day in the market. I want to add it on a down day in the market. And today is an ideal day if the market, decides to close near lows. I'll be looking at it here this afternoon, not this morning. But, if the market does close near lows and the VXX is, up here in the 38, 39 area, I'd rather pick it up there than having to pick it up when it's down $4 or $5, the next day and chase it on the downside. I'd rather try to top pick with it than chase it, just simply because of the option values and the fact I'm giving myself so much time. But one thing I have to keep in mind, and the one reason I'm not super eager to jump in right here, right now, is because when you look at some of the pullbacks in the market and you look at the VXX, it has a tendency to stay at its highest levels for 3, 4, 5 weeks. So it's just one of those where, do I have to jump in right here, right now? No, I don't. I don't. And so if I'm going to get into something that changes my ability to be patient, then I'm going to stay out. Because right now in this market, the only things I want to be involved with are things that I can be very, very patient with. Otherwise, then I have to deal with panic. Then I have to deal with, on the upside, what do I do? On the downside, what do I do? And let's face it, most of the upside downside movements have very little meaning in the market right here and right now. The last thing I want to do is have to put or associate some sort of meaning here to them. So hopefully that helps, kind of showing a little bit of what I'm doing and kind of my thought process throughout all of this. And, I know it's different for everybody. Everybody has, a little different, monetary situation, exposure situation, risk tolerance, and everything else. So you have to kind of find what you're comfortable with. But, that's ultimately what I've been doing here during this time. And, I'm not saying it's right, not saying it's wrong, just it is what it is there with it. So thanks for hopping on. Have yourselves a fantastic day, and we'll talk to you this afternoon. Take care.